What's going on, everyone? And welcome to episode number 3 of Migrate Your Money. I'm your host, Jeremy Crocker, and alongside me today, as always, is my co-host and certified financial planner, Drew Fikes. In today's episode, we talk about how we believe that wealth management equals financial planning plus investment management, and that it's more than just placing investments or insurance products and then moving on. It means helping people with all aspects of their financial life, not just the areas that an advisor might get paid for. We then dive into which concepts make up financial planning. These are topics like discussing your goals, cash flow planning, debt paydown, retirement planning, insurance and risk management, tax planning, college education planning, employee benefits, estate planning, and then everyone's favorite, portfolio management. We dive pretty deep in this episode, and I'm very excited for you to hear it. So without further ado, please enjoy this episode of Migrate Your Money.
I don't know about you, but I have a live studio audience today.
Oh, you do?
Yeah.
Who do you got, old Gus?
Old Gus down here. Our first hire, 2 weeks in.
First hire? What about old Finn?
Yeah, but he was a founder.
Yeah, you're right. He was one of the founding partners.
Yeah. So if you don't know who Gus and Finn are, then go check them out on the website on the About Us page.
Yeah. Recently added. Some great headshots, I might add.
For Finn, yeah, he looks like a model.
Well, Gus is still a puppy. He's got some growing to do.
Yeah, he's not very good at sitting for pictures or sitting for anything, really.
Yeah, unless he's going to the bathroom.
Yeah, that's about it.
Yeah, in the living room or something.
Yeah.
Oh, man.
All right, Jeremy. When you hear the term wealth management, what do you think of?
So when I hear the term wealth management, honestly, I think of like a corner office, some guy sitting behind like a nice massive like desk, just like managing funds. And so that's what I hear of when I think wealth management. I think of like an office on Wall Street or some some guru, so to speak. So I mean, what about yourself? When you hear the term wealth management, what comes to mind for you?
Yeah, I think that's probably what most people think. I think, when I think of wealth management, it's probably different because I have a different perspective, right? But I think of it more like to me, it's helping someone in all aspects of their life. So, it's kind of helping a client understand where they are. So kind of like their current situation, right? Where they want to go. So their goals, what they want to accomplish, and then helping them figure out what steps, action items, whatever it might be, recommendations need to happen kind of in between those to be able to achieve the goals. So it's, what are the outcomes that you're looking for? What are the goals that you want to accomplish? How can we help you with that? And, I think I probably said this in one of the other podcasts that we recorded, but I kind of think of wealth management has 2 components. So you have financial planning and investment management. And I even think of it as kind of like a formula in my head. Of course I do, right? Like what wealth management equals financial planning plus investment management. So, you could go somewhere and they would just manage your investments for you, not do any financial planning, right? Or you could go somewhere that would do financial planning for you and they don't want to manage your investments. But we kind of do both for people. So that's like where the term wealth management comes from. And it's not only for rich people, probably like you're saying, some guy on Wall Street in a corner office you probably think of like they're working with rich people, right?
Yeah, most definitely. The people that can afford something like that.
Yeah. So I think we can probably today during this conversation dive into really what financial planning and investment management mean. Because I think a lot of people probably think that they mean the same thing,
Yeah. I think people outside the industry are probably like, isn't that, that term is kind of can be used interchangeably, right? Because they don't know. And that's something that I've seen, out there as well is like this industry is not severely overlooked, but in a sense it is, because to the general public, it's just a bunch of mumbo jumbo, right? Like, I don't understand what's going on here. And it's crazy that there's no one that explains this to people. So yeah, I mean, I think that'd be terrific if we can give, them an understanding of what that really means.
Yeah, for sure. So I think we probably hit high level on this, maybe in the last podcast recorded, maybe the kind of our introduction one, I think. But we can kind of dive down and give some examples, so it's a little bit more concrete. But I think the first place to start here, in my mind at least, is kind of explaining that us as, I guess, wealth managers, financial planners, whatever the job title is, right? We kind of act like the quarterback in a client's financial life. And that's like probably an overused cliche in the financial services world, but we can, what was that?
I was going to say, just like the comprehensive wealth management. Yeah, for sure. Of course. Yeah. Right. But
I mean, if you run with it, we can call the plays, we can do some of the things, but we can't do everything for people, right? There's just some things that people have to do on their own.
So I want to stop there. I want to stop you there for a second, because, some people might say, well, why would I hire then if you can't do everything? Could you explain that a little bit further, I guess, detail, as opposed to why we can't do certain things?
I mean, I can't go pull your credit report for you. I guess I could, but, I'm not gonna be able to go and get insurance policies for you. If you need life insurance or something, I'm not gonna be able to do a blood test for you.
Right.
Like there's just like all these things similar to that people don't think about that, we just can't do. I can't make you go and sit in the estate planning attorney's office and tell them what you want to happen if something happens to you and sign those documents, all those types of things.
Yeah. But like you said, serving as the quarterback, you can call the plays and tell them what route they need to run or whatever that might be.
Exactly.
Perfect.
And another maybe less of a cliche example that I don't know, I heard something on a podcast the other day and it made me think of it, but somebody said something about a puzzle and I was like, that's kind of a good analogy. It's kind of like we're helping clients put the puzzle together, but we don't have all the pieces. So it's like us as the financial planners, the advisor, we kind of have the box, the front of the box, you can see the finished picture. You can see what it's supposed to look like. And the client has the pieces, but some of the pieces are missing, right? So then other professionals like attorneys, CPA, state or insurance broker, whatever it might be, they have the rest of the pieces that we need to finish the puzzle. So we need help from them and we need help from the client to go get all those pieces so we can get the puzzle done and then get the job finished, right?
Yeah.
So let's dive in. First, go into financial planning. So I mean, really kind of the first thing to do in financial planning is figure out someone's goals, right? So
yeah,
probably, I mean, typically, people think of retirement. Now, a lot of people are thinking more of like financial independence or maybe getting to a point where they can work part-time instead of full-time or something like that, travel, home purchase, vehicle purchase, college education, gifts to children, things like that, I think are probably more of the more common goals that people think of.
Right. And for me, honestly, this part is my favorite section. I know it's not the most data driven or anything like that, but I really do. I enjoy getting people's goals because, and I think it's one of the most important parts too. I think it might've been two episodes ago. You mentioned something about having a plan without any goals, right? I mean, that's an investment. That's a strategy, right? If you want to earn the highest return that you possibly can, that's great. But what's the point of that? Why are we doing this? Where are we putting this money towards? Do you want to use it towards college education? Do you want to have at retirement? Do you want to have a lake house somewhere? Whatever that might be. So this is, in my opinion, the most exciting for us because this really gets to this allows us to figure out who that person is or who that individual is. And it allows us to plan for something tangible.
And I think probably a lot of financial services firms don't go into this as deep as what they could to be beneficial to the client, where it's like, hey, hand them this questionnaire, probably even a paper questionnaire, write down your goals or check them off or whatever, so that we can put them in our software so that we can say that we did that. And then we can actually go to the things that we want to do and do the nerdy analysis on number stuff rather than focus on, like you said, kind of the end goal. What are we actually striving towards, you know?
Yeah. So you can't automate this section, in my opinion. Like
No.
you can to an extent, but like you said, most financial advisors or financial professionals just want to send you a spreadsheet or send you like a questionnaire, fill this out. But in my opinion, it's digging deeper into it and really understanding the aspects of why we're doing things. So like I think you can't automate it.
Yeah, I think that you can send the questionnaire, right? But there needs to be follow-up on it.
Absolutely. Yep.
And
I agree with that.
Even just something that I've been thinking about lately is you have to kind of toe a fine line, I think, but asking people what's on your bucket list, you know, because maybe, I mean, just truthfully, sometimes it might not be realistic for their situation, but maybe you can find, you know, something on their bucket list that they want to do. And maybe that's just not realistic, but you could scale it down or figure out how to do something similar to it, you know?
Yeah. Yeah, I agree. And sometimes that's an uncomfortable conversation that you have to have, but unfortunately you have to have it, you know?
Yeah. So I think after goals, unless you have anything more to add there.
Nope. Got nothing.
Probably like cash flow planning is the next place to go. And a lot of people, when they hear this, they probably think of like budgeting or someone looking through your bank account, all of your transactions, you know, which I don't want to do that. Do you want to do that?
I certainly don't want to do that. And I know the client probably does not want that to be done either.
Yeah,
so
that sounds terrible. So I always think of like helping people with reverse budgeting. So, hey, let's save what we need to save, or more like invest what we need to invest, right? Retirement accounts, whatever it might be. Make sure that we're paying down our debt appropriately, whether, you know, whatever debt there is, we have a debt pay down plan, getting that all knocked out. And then if there are other goals outside of retirement, like, I don't know, buy a home or any of those other goals that we talked about, travel, you know, make sure that we're saving for those. Do whatever you need to with the rest of it, you know?
So you're not one of those advisors that want to nitpick on espresso or like the coffee drinks from Starbucks and stuff like that. Is that what you're saying?
Yeah, I think
to an extent.
I think I like the way that Ramit Sethi puts it, right?
Yep.
Focus on the $30,000 problems, not the $3 problems.
Right.
He doesn't say problems. I can't remember what he says, but you know what I mean?
I think he says issues or something along those lines.
Yeah. I mean, though, in cash flow planning, like something to always keep in mind with people who are working, at least, which is kind of our main focus, is going to be people that are still working. So like when you get an income increase through a bonus or a raise, making sure that you don't spend all that money, right? Because that just makes you continue to spend more. You know, of a term kind of in the industry is lifestyle creep. But if your savings aren't keeping up with that, that just makes it that much harder to retire.
Yeah. And I think that's overlooked too, because, you know, I forget where it was, but if you're making, you know, say $100,000 and you're saving, you know, 20%, 17%, that has to adjust, right? If you do get bumped up to 120 or whatever that might be, because the realistic scenario is the more money that you make, the more money that you're going to spend.
Yeah.
Right.
It's like if you make $100,000 and you're saving 5% of your income, so $5,000,
right? But
you look at it as a dollar amount, then next year, you know, you start making 110 and you're still only saving $5,000. Well, you're not saving 5% anymore, right? And then that continues over 5, 10, 15, your whole career. Well, now you're used to spending all of your money, but you haven't saved and invested enough to be able to replace that in retirement, right? So now you could be in a position where you have to drastically decrease your lifestyle or run out of money.
I was just going to make mention of that. So it's a lifestyle creep, right? So you save, I'm saving 5%, and then that continues. You know, you continue to save just the dollar amount of 5,000, and then you get up to 40 and 50, and you're like, oh crap, retirement's coming up, and I've made all this money, but I'm not sure where it is because I've only saved to 5,000. I haven't adjusted it with me. And then now, like you said, you're trying to adjust your lifestyle and set yourself up for retirement when you've got only 10 years or 5 years left. And it's like, I don't know what I'm going to do, you know? Whereas if you would have just had a a plan in place at the beginning and followed suit, then it'd be a whole lot easier later on.
Yeah, for sure. I mean, on one hand, it's more difficult, right? It's easy to spend money. It's difficult to save it. But in the long run, it's easier. I think what is Jocko's, it might be his book title, right? Discipline equals freedom.
I was just going to mention that. Yes.
Yeah. Then kind of in cash flow planning, just because it's top of mind for, we kind of focus on working with people in their 30s and 40s. A lot of them have kids, daycare, right? Daycare is crazy expensive. And so going into having a kid, you have to figure out, how are we going to pay for this? But then also, once they transition from daycare to kindergarten, if they're going to public school, now we have all these extra funds. It's not all going to be there, because you're still going to have to pay for other things for the kids, or after school care, preschool, before school, but there'll probably be some left over that you can make a plan for, so.
Right. Yeah. It's finding the dollar somewhere. You can always find something, right?
Yeah. I think probably next one is probably similar to cash flow planning, though, is debt pay down prioritization, so we have figure out what's out there, maybe have a mortgage, auto loan, student loans, credit cards, whatever it might be. Okay, take an inventory, figure out how do we want to tackle this? Do we want to pay down this debt fast? Do we want to invest money that we have? Do we want to kind of do a combination? It comes down to financial planning isn't always, I guess you can't always do the mathematically optimal thing, right? And I think a lot of times debt, it's probably not going to be mathematically optimal, because people have feelings about it, and it can suck to have a lot of debt, even if it's like quote unquote good debt, or it's low interest rate or whatever it might be. So it's kind of talking through that, figured out, hey, do we want to do the avalanche, the debt avalanche, where we pay off the highest interest rate first, or the snowball where we pay off the lowest interest rate first, or some sort of in between?
Yeah. I was just going to mention, like, what's that saying that the best financial plan is one that you follow, right?
Yeah.
So same thing goes for debt pay down strategy, right? It's one that you follow and one that you continue to, and the one that allows you to sleep well at night too. That's one thing that I've noticed as well, is that if you're saving every single dollar and, towards retirement and whatnot, and you're not able to sleep well, then you're not going to want to follow that long term.
Yeah, I think you make a great point there. We could come up with the most mathematically optimal strategy to pay down your debt, but if you follow it for a month and then you quit, it wasn't the most mathematically optimal anymore, right?
Right. Yeah, absolutely. And I mean, that, like with debt pay down too, but like back with the retirement savings, which I think is our next session with, retirement and planning retirement planning and savings, like same thing along those lines. So like, how much do you want to invest to like reach your goal and stuff like that? So I guess, could you touch on this space a little bit, and this side of the, I mean, a lot of people understand this retirement, right? They want to get to that, but I don't think they really understand exactly what goes into it. So if you could hit on this, I think that'd be huge.
And I think a lot of people don't really understand how much you really need to be saving and investing for retirement,
Yeah, that's a good one.
a lot of people think if I get the company match on my 401k, then I'm good, or, whatever it might be. And it all depends on your goals too, right? I think it's kind of our job to show, here's what happens if you continue the way you are. And maybe you do, maybe you don't reach your goals, just depending on what you're doing, right? Here's what you need to do to reach your goals if you're not, on track for that. So it's just like you said, like, how much do I need to be investing for retirement? What accounts should I be investing them in? Whether it's your 401k or IRA or brokerage account, or, whatever makes sense for your particular situation. That it's not going to be the same thing for everyone.
Yeah, I agree with that. So I guess I got a question on that part then. So how do you analyze it? And then like, how do you say, hey, at retirement, I'm going to have X. Like, I know there's got to be some kind of software or something, right? That kind of runs the probability of, I guess, how things are going to be going at retirement. Cause some people don't really know. Right. So, I mean, how do you really dig in and find out what it's going to look like for an individual?
Yeah, I mean, you could use a spreadsheet if you wanted to, right? But kind of like you just made mention to, we use financial planning software. It's called Right Capital. There's a bunch of different ones, but what financial planning softwares do is they run what's called Monte Carlo analysis. So Monte Carlo analysis was actually originally invented, I guess that's the right word, to like model gambling outcomes, right? So think of like, hey, if I make this bet, what's the probability that, you know, this happens or this happens? So in Monte Carlo analysis within a financial planning software, you know, you put in all the information. Hey, here is the portfolio. Here's how much we have saved. Here's how much we save each year, invest into the portfolio. Here's what our goals are at retirement. So here's how much needs to come out, right, each year. And you know, you're going to put all the information in there. If you have social security, pensions, all that stuff, that's going to be there. So a lot of times it'll run 1,000 trials. So let's say, Jeremy, I put your financial plan into the software. You know, I have all your information in there. It runs 1,000 trials. It takes into consideration the average rate of return that we're using for whatever portfolio you're in. And and what it does as well is, instead of just saying, hey, you get that same return every single year, because that's not what happens, right? The market goes up and down. It does crazy things.
Oh yeah.
It
Experiencing
takes
that right now.
yeah, no kidding. It takes all those things into consideration. So maybe, you know, one trial, the first 5 years are down years. Maybe, you know, one trial, the first 5 years are good years. And it's changing every single year, right? But it's getting back to that average. So it's much more accurate than if we were just to use a spreadsheet that can't account for that volatility, you know?
Right. Yeah, certainly.
So then what it does is it spits out a probability of success. So it says, hey, if at the end of Jeremy's age, 95 or whatever age we're using, if there's $1 left over, that's a successful trial, you know? So then depending on how old someone is or what their risk tolerance is, I guess, you say, hey, we want to target this percentage probability of success. Maybe it's 80. Okay, we came in at 65. What triggers can we pull? What levers can we pull in this plan to get you up to 80? Oh, maybe you save more. Oh, maybe you spend less. Maybe this, maybe that. You know, I mean, pretty much anything, any lever that you can pull, you can kind of test it and see how it affects the probability, how it affects the plan. And then that gives information to the client to be able to make a decision on how they want to move forward.
Yeah. I think that's very helpful, because a lot of people haven't seen something like that before, right? I mean, like you said earlier, a lot of people just say, if I'm saving X amount of my 401k, I should be just fine. I'm getting a match, right? So I think that's huge for people to see and really, and not necessarily see. I think it's huge for people to have someone there to explain it to them, right? Because it's cool to have, this is the Monte Carlo analysis. This is how it works. But if I'm someone that isn't in the industry and doesn't see it every single day, it's nothing to me, right? It's just a chart, right? So having someone there to explain, I think, is huge to really understand what needs to happen for that long-term goal of retirement.
Yeah. And I think also, you know, there are free tools online that you could use to do a Monte Carlo, but it's also understanding the inputs, the assumptions that are in there, right? Like what inflation assumptions are we using? What return assumptions? What social security assumptions? What, you know, correlations within asset classes within the portfolio we're using? There's so many different things like that also kind of need to be considered when you're doing that.
Yeah, I agree too. And it's like, you don't really know what to put in. So
yeah, so good there.
Yeah, I think I'm good. That was a pretty deep topic. So
yeah, next one, I would say we could hit this one at a higher level, but I think there's probably a lot of like examples that I have for things in here, but like insurance and risk management. So, you know, part of risk management is making sure that you have a proper emergency fund in place, you know, make sure you have cash on the sidelines in case something goes bad.
What would you recommend for that? Because, you know, I've always heard different stories, right? I've heard 3 to 6 months, but what about if you're married? What about if you're single? What would you say is typical for the amount of cash that you would need laying around for an emergency.
So, I don't know your or anyone else's financial situation, so
Of course.
no recommendations, right? But
Yeah,
generally, like you said, you always hear the 3 to 6 months. And again, I think that this is something that goes back to what we were talking about earlier. How do you feel about it? What helps you sleep well at night? But if you have a two income household and you both really have really stable jobs, then you could probably be on the lower end of things, right? But
right.
if maybe you're both 100% commission and if you miss a week or a month or whatever, you could get fired at any time, then maybe you should be on the higher end of things.
Yeah, that's what I was looking for. Is we were sitting down with a client actually last week, and they had asked us, well, what do you think I should do with this? And it's like, of course we gave them, I'm not sure what kind of recommendation we would have, right, until we run the full financial plan, because that's the first thing we have to do is get all the information, gather everything that we need, make sure the data is accurate, and then put together an accurate financial plan, and then we can decide what we want to do.
Yeah.
But ultimately, the short answer was, well, what's going to make you sleep at night, right? If you have all this money sitting in the bank and you think that you can, put it to work for you or invest some of that and still be able to sleep at night, then that's going to be the right answer. Because if you're going to be waking up every 30 minutes and not able to sleep and just thinking about it, and then the market goes up and down and sideways, and you're like, I gotta get out, then it's not a good, then you need more of that emergency fund or whatever. So just a quick short answer to that, I guess. But
yeah, no, exactly. And then kind of on like the insurance side of insurance and risk management, it's not like we don't sell any products, right? So we're not selling anything. We're reviewing policies, kind of analyzing, making recommendations, anything that we see. And if there's anything that we see that needs to be changed, then making a referral to a broker that we trust. And I always try to refer people to an independent broker, because rather than just being tied to one company's products, they can look at however many they have an agreement with. They could look at 10, 15, 20, 30 different insurance companies' products and help you get the best one for your situation.
Yeah, I think that's huge. I think that's huge, because a lot of the times, exactly like you said, right? They're going to want to offer their product because they get paid more commissions on it. So
yeah, when your only tool is a hammer, everything looks like a nail, right?
Right. That's really good.
So life insurance, whenever I look through policies, I'm always looking for, first, kind of like you said, we're going to run the plan and we're going to see how much life insurance we think someone needs based on, hey, worst case scenario, if something happened today, what would your family need to be able to continue this plan, right? So what that would be like the death benefit on the policy, the length of term on the policy, and whether, someone might need term insurance or permanent insurance. The premiums, if there's a policy that's already in place, do these premiums look good? Do they look high? Should we see if we can get quotes and get a better policy? And then, what riders might be on there. If there's something that we see that, maybe it's like, I don't know what that is, get a broker involved to help us. Or if there's something that we see, it's like, hey, I think you're paying for this and you probably don't need it, then, there's just different things there to look at.
Yeah.
And then disability insurance. So this is one that I think a lot of people, they're fine with getting life insurance, right? But disability insurance is more expensive. Why? Because it's more likely that you're going to become disabled than you're going to die. I mean, the underwriters at the insurance companies know what they're doing, right? They're pricing these things appropriately. So I think a general rule of thumb is probably disability insurance is 1% to 3% of your income annually, to get probably like 60 to 70% income replacement rate. So if something were to happen to you and you couldn't work, then what's going to happen? You're going to wait like 3 years to get on Social Security disability, or you're going to have a private policy in place that's going to replace income and help you and your family out.
Right. So a lot of people think that that's where the emergency fund can kick in at, but the reality is that 1 in every 4 people are going to have a disability at some point in their life. Right.
Yeah.
And the emergency fund is going to dwindle quick. It's only a 3, like we mentioned earlier, it depends on the situation, but 3 to 6 months usually. And sometimes those disabilities last a lot longer than that.
Yeah. And I mean, just think about, I mean, if multiple things happen at once, right? If maybe you got in a car accident and it made you not able to work, and then also your furnace in your home went out, or you need to get a new roof or something like that. I
Yep.
did, who knows what all could happen at the same time. But when one thing happens, it all comes falling down, right?
Of course.
So on disability policy, probably number one thing I'm always looking for is the definition of disability. So, there, each carrier kind of has their own definitions, but the one that I'm always looking for is own occupation. So, Jeremy, if you're a surgeon, doesn't have to be a surgeon. I just threw that out there. I don't know why, but and you become disabled and you're not able to be a surgeon, then the policy pays out. But if you have an any occupation policy and you're a surgeon, you're, construction worker or whatever it is, doesn't matter, and you can go be a greeter at Walmart, it doesn't pay out. So that's like where the any occupation definition is really important. It costs more because it's better, right? And it's more likely to pay you.
Right. Yeah.
In
Something that's
income
left over big time.
Yeah, absolutely. Income replacement rate. So like I kind of mentioned earlier, how much of your income is going to be replaced if the policy pays out? A lot of times 60, 70%. The insurance company doesn't want to incentivize you to sit at home if you get over your disability, whatever it was. And maybe now that we've gotten halfway into this, maybe it's good to kind of explain, people think of disability, I don't know, maybe they think like you just can't even do anything, but
Right.
the most common ones are like hurting your back or mental nervousness. So having, something happen and you're not able to work because of mental reasons, mental health reasons. Like, for a surgeon, could be hurting their hand, or, there's like all these smaller things that people might not think of, that these will help you if you are not able to work because of that,
Yeah. Yeah.
I think cancer and like heart attack or stroke or something, those are two of the big ones in America as well. But so now that I should have said that first, but then on the disability policy, you always also want to look at the riders. So does it have a cost of living adjustment on it? And of course, these riders are going to increase the premiums on the policy because they're making the policy better. But, we're seeing inflation at 8.5% right now. If this policy starts paying out and you have increased inflation over a long period of time and these benefits don't increase with it, that's going to make it tough on you if you don't have another way to earn income. Increase options. So maybe, you just got out of school and you're making 50 grand and you're going to be able to ramp up quickly based on the career that you're in. So the increase option says, hey, when you can increase this by $10,000 or whatever it is, and each year you have the option to go in and buy up more coverage. And then like residual disability riders. So maybe you don't have to be 100% disabled, but you can't do 15% or more of your job. So then it doesn't pay the whole benefit, obviously, right? But it pays whatever percentage that you can't earn anymore because of whatever happened.
Yeah. Okay. So I actually have a question, like still on the risk management side, right? Because I think a lot of people, when they hear, when they sit down with their advisors, they touch on life insurance and disability a little bit. But what about all the other insurances out there, like say homeowners or auto insurance, things like that? Like, how could you optimize that, or what would you be looking for when reviewing those types of insurance plans?
I think that a lot of people don't look at those.
Yeah, that's what I'm saying. I mean, I think a lot of people out there sit down with their advisor and they'll review the life insurance, they'll review their disability, but no one looks into those because I think it's just an overlooked subject, that I don't know. I think it could be optimized.
Yeah. And I mean, I've always looked at them because, when I went through the CFP process and the studying for the test and everything, it's in the book. So I guess I just thought I was supposed to, but I found that it seems like a lot of people don't. But for example, homeowners insurance, like you said, look at the premiums. Do the premiums look right? Do they look really high? Then, if they look really high, hey, have, you had a claim on this policy? No, maybe we should get quotes and bring that down. Like last year, I was working on someone, their homeowners was like $3,000. It's like, whoa, this is high. Have you had a claim on this? No. Okay, let's get a quote. They got a quote for like 1,600 or something, for, and
nearly
and
half.
Look, you could get a better quote but it could be crappier insurance, right? It could have less coverage, but this was not the case. Homeowners, so replacement cost or actual cash value. So what this means is probably most policies, maybe I shouldn't say that. A lot of policies that I see are written with replacement cost, which is what you want. If your home is destroyed today, what does it cost to replace that? Well, it's not just the cost of the building materials, right? You got to get a crew in to clean out everything, to get rid of everything. There's big costs there. You got to build the home. You got to, if there are other buildings on the property, rebuild those if they're destroyed.
Also, not to mention the lost time, right?
Yeah.
Because now, like during that process, where are you living?
Yeah. And policies will have that in there as well sometimes. And, it might be something that you want in there. Or actual cash value is probably what you don't want, where it takes into consideration depreciation. So, if your house is 40 years old, and they depreciate it for those 40 years, maybe you're not going to get paid out enough to rebuild a house,
especially with the housing market the way it is today.
Yeah, no kidding. The amount of coverage, so the amount of property coverage that you have, the amount of liability is a big one. I mean, property, yeah, of course you want to be able to replace the home, right? If worst case scenario, but liability, if someone gets hurt on your property, or even this can extend to outside of your home as well. But, if you have kids and your kids have friends over and a friend breaks their arm or leg in the yard or something, that's your liability, and your homeowner's policy will probably, it's going to be the first line of defense against that.
Yeah. And, I think that's, man, there's so much in here. There's so much in here that I think people can take away from this, because like, some of those issues, I think no one's even thought of that before. Right.
Yeah, for sure. The deductible. So I just looked at my policy right before this, $1,000 deductible. Sometimes, a lot of times people have $500. What's the difference? $500. I guess for some people that could be a big difference, but it's going to decrease your premiums the higher your deductible is, if you can afford that, right? And probably if I had something happen to my house that was going to cost $1,000, I just pay for it out of pocket rather than run it through my insurance, because that if I run it through insurance, then it's likely that the premium will be raised at some point because I made a claim. Roof replacement, that's a big one. So, do you have the replacement cost coverage on that, or do you have the actual cash value that we talked about? Because, if your roof is 12 years old and you get hail damage and you want insurance to replace it, well, and they depreciate it down, from those 12 years that you had it, they're not going to pay for a new roof.
Did you say hail damage?
Yeah.
Okay. Just
Why?
make sure.
Thought I said hail damage.
Say hail damage one more time for people, please.
Hail damage.
Thank you.
And then the other one that you mentioned was auto insurance, right? So
yeah,
kind of looking at the same thing here, right? Premiums. One that I always look at is renewal frequency. So this is actually a tip that a home and auto broker gave me, but I have mine set to renew annually. Whereas if you have them set every 6 months or every month, then that's more times that the company could increase your premiums if you got in an accident or you had a claim for some reason, right? Whereas if, my insurance renews in January and I have an accident in January, they're not going to be able to renew or increase my premiums until the policy renews again in January.
Yeah.
And then, liability limits on your auto as well. there are state minimum liability limits in Indiana. You probably want higher than the state minimum because, if you get in an accident, and even if it's, just purely an accident, and you hit a family of 4 and they all have to go to the hospital, those bills add up quickly. And then go back to the example I used earlier. What if that's a surgeon? What if he can't work for 3 months and now you're supposed to subrogate that income for him because, they're suing you for that? That's a lot of liability for you.
Yeah.
And
it's
then,
worst case scenario, of course. We hope this never happens, but unfortunately stuff like this does happen,
Yeah. I mean, the point of insurance is to insure against catastrophic events, right? That would be catastrophic. And then auto, if a client has an old vehicle, look at, does it make sense to have comprehensive and collision coverage? Because sometimes it doesn't. If the vehicle's old enough, right? Like, you might be paying premiums and maybe you're going to get $3,000 of insurance to pay it. Well, it doesn't make sense to pay for that. If you got in an accident and the vehicle was totaled because it's old,
Yeah. And I think most of the time too, people are like, yeah, just add it on there. If they can afford the premium, just add it on there, just add it on there, just add it on there. Well, sometimes they may not need something to that effect.
Yeah, for sure. And then kind of with those two, is it appropriate to have an umbrella policy? So an umbrella policy, literally think of an umbrella. So you have your home owner's insurance, you have your auto insurance, and the umbrella goes over those. So it provides an additional layer of liability coverage. Usually, it comes in like, I don't know what the correct word, I can't think right now, tranches, I guess, of $1 million. So, you might be able to get a $1 million umbrella policy for $250, $300 a year. Don't quote me on that, but I kind of see those a lot. But it just depends on your net worth, or if you want to be more cautious and have that there in case of a big claim, or especially if, like, for wealthier people, if your net worth is greater than your liability limits on your home and auto, then it probably starts making a lot more sense to get these policies in place. Then I think probably the last one in insurance, health insurance, which we always look at all employee benefits, but sometimes people don't have health insurance through their employee benefits, right? But kind of, again, comparing everything, look at the premiums, the deductible, max out of pocket. Whenever I'm looking at an employer plan, a lot of times people will pick whichever one has the lowest deductible. But a lot of times, mathematically, if you run out everything, you compare everything, the premiums, the deductible, the max out of pocket, and if there's an HSA plan, if the employer makes the HSA contribution, a lot of times the HSA plan actually wins because premiums are lower. You're getting the HSA contribution, which you could kind of mentally account as lower premiums as well, and a lot of times the max out of pocket is similar. So, and it's just going a step or two deeper instead of just saying, hey, this one has the lowest deductible. Let's go with that.
Yeah. Which I think most of the time wins, but
yeah.
Okay. So enough with the insurance side. No, there's a lot to it. There really is. And I think a lot of this side it's like I mentioned earlier, it's overlooked, and it's just, most of the time people set it and will never look at it again, and that's what I think is huge and is a big, not necessarily hole, but a way that you could optimize your portfolio in general and your whole financial planning scenario in general as well, because this could be a potential way to help you, reach some goals later on. But I did want to talk about like tax planning as well, because I think a lot of people, when they think tax planning, they think their CPA is going to handle it, right?
Yeah.
So I guess really diving into what tax planning is and how it's forward looking and long term, as opposed to what what a typical CPA or a tax consultant or a tax filer will do is they looked at years past and where'd you spend your money at, what kind of income did you have, and how are we going to file that tax. So let's dive in a little bit deeper to the tax planning aspect of it.
Yeah, so I think you're exactly right. a lot of times, this isn't all the time, right? But a lot of times the CPA is backwards looking, right? They're a compliance expert. They're making sure that what happened last year is filed correctly with the IRS. And, they have potentially hundreds of tax returns to do in a couple months, and that's really stressful. And then they don't want to look at it again, which
I don't blame them.
yeah, exactly.
I mean, yeah, that's a lot of work to do in a short amount of time for sure. I would definitely need a vacation or 12 after that. So.
Yeah. So then we'll review the tax return, see if, if there's ever anything off or anything that we think, hey, we have questions on this. Can we consult with the tax preparer? And then, see if there's any opportunities for this year that we could take. So, compare the pay stubs, compare the tax return. Hey, what does this year look like from an income and tax perspective? Anything that we should be taking advantage of? Sometimes this might be retirement savings. Should we do Roth? Should we do pre-tax? Should we save your 401k and your IRA and your brokerage account, your HSA? Kind of come into those determinations. Are there any charitable gifts that you want to make? Are there better ways to do that than just write in the check to the charity? Like top of mind, donor advised fund. That can be a way to help people with taxes. Maybe we can dive into that in a different podcast in the future. But high level, those are kind of some of the things that we're looking at when it comes to tax planning.
Right. And then, so earlier too, let's transition into the next topic then. So we did mention one of the goals, right, is to, most of our clients, they have kids. They're starting to plan for the education, not necessarily just college, but it might be, they might have private school that they're planning for in, high school, middle school or whatnot. So as far as the college education plan goes, right, it's us coming up with a strategy for that. And, there's different, I've seen a lot of questions on this. Should I use a 529? Should I do a brokerage account? So I wanted us to kind of talk about this a little bit as well, on maybe what plan might be optimal, or just kind of a higher overview with this, because this is a part of our financial planning process. So
yeah, I think it, like you just said, it starts with, what do you want to do? Do you want to pay for 100%? Do you want to pay for 50%? A lot of times I find that people, they'd rather plan on paying for 50% and making their kid have some skin in the game.
Yeah. It also goes too, I mean, are you going to go to private university? Are you going to go to in-state, out of state? Like that's all taken into consideration as well.
And like considering what inflation rate are we going to use? I mean, historically, college education is inflated at a higher rate than general inflation has. So, is that something that we want to plan for as well?
Yeah. Yeah, I was going to say, I think that's a severely overlooked topic as well. It's, what's it cost right now? And then they'll formulate a plan around that, but not taking into consideration inflation rates and everything, that comes along with it, room and board, all that stuff, that's going to be going up. So,
yeah. And then, like you mentioned, how are we going to pay for this? Are we going to use a 529 plan? In Indiana, you can contribute up to $5,000 to the 529 and get a $20 tax credit. So if you contribute $5,000 to the 529, then you get $1,000 credit on your Indiana state tax return, right?
Yep.
But there are penalties if you don't use it for education. So do you want to completely fund the 529 for all of the college education, or do you want to use another account or source for the rest of it,
Right. And like, that's a big question that's been brought up too, because, correct me if I'm wrong, but from my understanding, that can be used, the 529 plan can be used for not just college education, but also trade schools as well.
Yep.
That was just brought into, I think it was a couple of years ago that got passed, right?
Yep.
So that's something that could be, because I think, the trades are starting to come up a little bit more too with the lack of workers they have. So a lot of kids are starting to look towards trade school. Well, the 529 plan can be used for that. And that way you don't have to get that 10%, a 10% hit if it's not used for college education.
Yeah, for sure. And I think, so you have the 529, if your child's working while they're growing up, you can help them fund a Roth, and then Roth contributions can be withdrawn tax-free, penalty-free. Brokerage account's always good. Brokerage account's really flexible. Yeah, maybe it doesn't have the pre-tax benefits or Roth benefits, but I really like brokerage accounts for a lot of things. Or even cash flow. At that point, kids might be off the payroll. You might have extra cash flow that can go towards paying for some of the college, right?
Yeah. As opposed to taking out loans.
Yeah. Or, make them take out a loan and then
make them. That's what we had to do, Drew.
Yeah. And then pay for it later.
It makes them appreciate it that much more, I think.
Yeah, for sure.
I would appreciate a nice gift, though. I will say that. A nice free college education. But okay, perfect. So then how about employee benefits? Let's go towards that, because I have noticed that too, is that a lot of people, when they are talking about the insurance, life insurance, disability, a lot of that's covered through my employer, right? I have life insurance through my employer. I have disability through my employer. But the simple fact of the matter, at least for disability insurance, is that, most of the time your disability insurance is not going to kick in unless you get hurt at work.
Yeah. I mean, like life insurance at work, if you change jobs, it's probably not portable. You probably can't take it with you, right? So you hope that your next job has life insurance available. And a lot of times I see, if someone's healthy, they could probably get cheaper life insurance through an independent broker than through work, because it's more expensive because they have to provide it to everybody, right? They're not doing medical underwriting. Sometimes if you reach a certain limit, then above that, you have to do medical underwriting. But the basic,
it's a guaranteed issue.
Yeah.
With the employee benefits.
Yeah. And the premiums probably increase every year, or maybe it might be like in 5-year tranches where you could get a, level term policy that the premiums never increase. But if you have medical issues, then maybe your life insurance and your employee benefits is your best option, and you just need to max it out,
Yeah.
And then like disability, like you said, a lot of times it has an any occupation definition in employer benefit disability policy. So hey, if you get hurt and you can't do your own occupation, but you can do something else, it's not going to pay.
Well, of course it does, right? Because that's the cheapest that the employer can get it at most of the time. So I could see that, I could see why an employer would want to offer that. And again, I think that's something that's overlooked because nobody really understands it. So when they see, oh, my employer offers it, it's got to be great. So, and that's something that we could do, is we can review those benefits and making sure that they are sufficient enough.
And one on disability through work too is whether it's being taken out of your paycheck pre-tax or post-tax. So if it comes out pre-tax, then if you were to file a claim and receive benefits, they would be taxed. But a lot of times what employers will do, they'll give you the option to, they do it different ways. A lot of times they call it an add back. So they'll have the disability premium taxable to you. So if you were to claim benefits, those benefits would not be taxed. So, there are a lot of different details to look at when you're looking through these things.
Yeah. Which someone with a full-time job probably does not want to spend time looking through everything.
Yeah. Then, I mean, we kind of talked about health insurance a second ago. A big one for kind of people in our target market is the dependent care FSA. So, if you have kids, you probably pay for daycare. And if you do, both spouses work. That's a key to it. Both spouses work, and you pay for daycare so that both spouses can work. You can funnel $5,000 through the dependent care FSA pre-tax, and it's pre-FICA, so Social Security and Medicare tax. Which, even if you make pre-tax 401k contributions, it doesn't go in pre-FICA. So there's $5,000 of daycare that you were paying for anyways that now you're not paying taxes on. That's some of the only money that you could potentially never pay $1 of tax on.
That's intriguing, Drew. That's intriguing. My ears perked up a little bit on that one.
Yeah. I mean, the same with the HSA, right? The health savings account. A lot of times if an HSA is offered, and the employer will make a contribution, but you can use that like a retirement account. Instead of reimbursing yourself for your medical expenses, this is what I do. I invest the money. Maybe not all HSAs have the ability to invest the money, but you can transfer the money to an account that does. And then, so it goes in pre-tax, goes in pre-FICA, like I just said, for the dependent care FSA, right? So no taxes at all on it. Invest it, and then it's growing like a Roth IRA. And then in retirement, I could say, hey, I've had all these medical expenses over the years that I haven't reimbursed myself for. I have all of it documented. I have it saved in a file on my computer. So I'm reimbursing myself for all these. Or you're going to have probably a lot of medical expenses in retirement to reimburse yourself for as well,
That's actually great. So again, I mean, things that I think that are overlooked, right? I mean, the HSA and the dependent care FSA, I think just people just don't know about them. As crazy as it sounds.
Completely right. No, you're right.
Like every client that I come across, they don't even know what those are.
Yeah.
So for you to say that's potentially one of the only avenues that you could be 100% tax free is just mind blowing to me, and no one even really has heard of it before. Like it's just wild.
Yeah, it is. I mean, kind of finishing this up here, equity comp, and this could vary like really differently. So just high level employee stock purchase plan. Some people might have that. RSUs, stock options. I don't see this so much, but the other two I see more. So, always reviewing those, making sure the client understands it, if they want to take advantage of it, what they want to do with the money. And then, of course, we're always looking at the 401k, reviewing it, looking at the funds, reading the SPD, the summary plan description, which again, something that no one's ever heard of, but it has a lot of important information in there.
Yeah. Also reviewing the like expense ratios and all that stuff like that. Like there's a lot that comes into that. Like reviewing, especially what you're paying in fees, because people, there's still fees that are accumulated with, or that you have to pay with the 401k or 403bs, people just overlook.
Yeah, for sure.
So, all right, well, let's finish off with dying out. I'm just kidding. No, but let's move into the estate planning topic, because this is a big one too, that I think a lot of people don't really know much about, because I mean, something that we handle, right? Just planning and it's not just planning in general, but kind of the preparation leading up to that. So can you dive into a little bit more about the estate planning side of it as well? True.
Yeah. And I think probably when people think of estate planning, they think it's something for old people or rich people, right? But I think it's probably something for most people, not just old people or rich people.
Just like financial planning and investment management, all that's just for the rich people.
Yeah.
Corner office and Wall Street.
Yeah. So estate planning, this is kind of another one where it's planning, not preparation, right? We're not preparing documents for people. You need an estate planning attorney to do that. So it's kind of, if someone has documents in place, reviewing them, making sure that what they say is aligned with what we hear the client say, because there can be some information lost in translation when someone speaks to an estate planning attorney, and when that gets written into a document, right? And if someone doesn't have them in place, educating them on why they should get them in place and making a referral to a trusted resource to help them get that done. And then, on the back end of it, once they have the documents, helping them make sure that these documents do what they're supposed to do by helping them get their beneficiaries updated on their accounts, or, getting assets titled the way that they need to be if there's a trust. So estate planning documents, there can be a lot of different documents in here. So it's essentially, what happens if I pass away? What happens to my stuff? What happens to my kids? Who's going to take care of them? All this type of things, like kind of dictating, I guess people a lot of times say controlling beyond the grave, right? But it's also, what happens if I become incapacitated and I can't make decisions for myself? So this is both financial and medical decisions, right? So the last will says, what happens to my stuff if I die? Who takes care of my kids? That type of thing. Living will is saying, hey, I want to be supplied artificial nutrition if, I can't make decisions for myself, or I don't, or leave it up to someone, or whatever it might be. Healthcare power of attorney. Hey, this person has authority to act on my behalf if I can't make decisions, or if, the doctor deems that I don't have the mental capacity to make decisions on myself or for myself. The HIPAA document, release my information to this person, whoever, if they need it. The general power of attorney is more the financial one. This person can make financial decisions on my behalf, and you could have it in place at signing, or you could have it at springing, which springing would be once I'm deemed incapacitated by, whatever you have written in there, 1 doctor, 3 doctors, something. And then the trust, so not everyone has a trust, but sometimes people want assets titled in the trust to avoid probate and for privacy when you pass. So, but the trust is only good if you get the assets titled appropriately in the name of the trust, right? If you have a house, it's supposed to be in your trust, but it's still titled in your name. Well, guess what? It didn't get into the trust, so it's not going through the trust.
Right. Yeah. Perfect. So then, final topic then for us then, let's run through, I guess what everyone thinks of when they think of investment and financial planning and everything like that, the fun part, the sexy side of things. Let's go through the portfolio management. So let's go ahead and dive into that and just kind of give understanding for what we would do and how we would handle certain things.
Yeah, I know I've probably been talking forever. We're probably going long. So we'll see if we can run through this a little quicker. I think
this
probably
is the fun
people,
part though, Drew.
Yeah, I think probably people understand this part a little bit more.
Yeah. This is probably the most researched topic, I'd say.
So we're managing all accounts for someone, right? So we've got our portfolio management system where we can see everything in one place, which is, a great benefit compared to, like, right now, personally, if I didn't have our portfolio management system, I have stuff everywhere, right? Mm-hmm. And it's hard to manage a portfolio when you can't see it all at once. So we're looking at it as a household rather than each individual account, right?
Yeah, let me stop you there because I think that's huge, especially later on, right? I think this is something that that getting established right now is huge because, like you said, especially when you start to change jobs and you got more, you have multiple statements, everything. It's nice because everything's in one location. Yeah. As opposed to getting a statement from, 5 different locations. And then you've got everything that you have going on yourself, your Roth, you've got, your traditional IRAs or whatever else you've got. So, it's really nice to have everything in one location, like you just said.
Yeah. You'll still get those statements, but you can see, but you can see everything in one place and like in our portal, right?
Yes. And yes, 100%. It's nice to see things right in one location.
Yeah.
I'm not necessarily saying you won't receive those statements, but like trying to do research on every single one and have to essentially have a spreadsheet for yourself or, whatever that might be. That's a no-go for most people. So
yeah. So we kind of have everything right there. So we can just constantly monitor it. Every time we log in, we can see the status. Hey, here's the asset allocation. Here's what the current, allocation of the accounts actually are. Do we need to make any trades? We mentioned this a couple podcasts ago, but we have an evidence-based strategy. We're not trying to time the market. We're not picking individual stocks. We're using mutual funds and ETFs, globally diversified. We'll talk about that here in a second. So asset allocation. Jeremy, one of my old mentors would ask this question to people. What's the riskiest asset class?
The riskiest asset class.
Yeah.
I'm going to say international equities.
It depends.
It depends.
So depends on your time frame, right? If your goal is 50 years down the line, the riskiest asset class is cash. Why? Because of inflation. If your goal is to spend money tomorrow, the riskiest asset class is stocks. Why? Because they have the highest volatility, right? So making sure that you have an appropriate allocation based on your goals, based on your time horizon, your risk tolerance, your risk capacity, all those things. And then making sure, like, kind of looking at the allocation of the portfolio from a stocks versus bonds standpoint. In stocks, looking at growth versus value, US versus international, large and small stocks. And then on the bond side of thing, long-term versus intermediate term versus short-term bonds, looking at the credit quality, corporate bonds versus government bonds. There's a lot of things to look at to really understand the portfolio and how it's performed in the past, and using that information to kind of think about how it might work in the future as well. And then since we have everything in one place, asset location, not asset allocation. Asset allocation is what we just talked about, but location. Where do we want these different asset classes to be, right? So high growth things, let's put them in Roth. Why? Because Roth is never going to be taxed again. So let's put the things that grow them, that we're projecting to grow the most, in there. Income producing things, let's put them in pre-tax. Why? Because pre-tax, we're not going to be taxed this year, right? We're going to be taxed once we pull them out. So if we don't have to realize extra income this year, let's not do it. And then brokerage account, taxable brokerage account, we could use it as kind of like a catch-all. Security selection. So, we talked about the asset classes. Okay, what actual mutual funds and ETFs are we going to use within these asset classes? So, we're looking at a bunch of different markers, the performance, fees, turnovers, risk measures, a bunch of different ones that I could pull up my spreadsheet and look at, but I don't have them all off the top of my head, right? And then portfolio rebalancing. So that says when is it time to make a trade? We're not just going to trade because we want to, or because we feel like it, or because the market's scary, right? We're going to have rules in place that tell us when to trade. And I think the last one really kind of there is coaching. So when the market gets scary and someone says, hey, I want to go to cash, it's like trying to help them remember, let's go back to the plan. What are the long-term goals? Yeah, the market's scary today, but is it going to be, is this going to happen for the next year, the next 30 years, whatever it is? Let's stay invested. Let's see what we can do to help someone ease their mind when things get a little hairy.
Yeah. I think that's a big thing too, is because you've heard it all the time, like, the best type of investing is no emotion, right? Having no emotion, just because when emotion is brought into stuff like this, it just gets the best of you and you sell when things are low, right?
Yeah.
So making sure that we're there saying like, hey, listen, this is a long-term game. Like, let's stay invested. Let's continue with the plan that we established. Of course, there's tweaks in that plan too, but let's continue on with that plan and make sure that we're still aligned with everything. So don't freak out too much, right? So,
yeah, for sure. All right, I talked forever. Anything else that we need to add in here that you think that we didn't hit on?
I don't think so. I think we touched on a lot today. So if you guys have lasted this far, thank you very much for listening and watching. Sure, there was a lot. I think obviously I loved it. There's a lot of great information in here, but
yeah, we probably have maybe 2 people that listen to the whole thing.
Hey, come on, give us some more credit than that.
They're probably giant nerds like me, just trying to see what I'm going to say. So like you said, I would say, if you found it beneficial, like and share. A reminder from the beginning, we specialize in providing fee-only financial planning and investment management, which we just went over for probably over an hour. So if that's something that you're interested in, you can go to our website, migrationwm.com. There's a request a free meeting button at the top right that you can use. No obligation, no sales pitch. It's just a opportunity for us to learn about you and what you're looking for, and if explain about what we do and if we might be a good fit to work together.
Also follow us on all the socials, right? That's going to be you can find that on our website, but we might sneak in a couple of funny pictures of our dogs every once in a while or something. So
but the branch manager and the chief of morale.
Yes, dang right, the CMO. But thanks for listening and thanks for watching. We'll be back soon.
This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of the information provided in this podcast is intended as investment, tax, accounting, or legal advice.